thus far. There will inevitably, of course, be more of these papers from both the people, but this is a very significant day with Mark Carney, the Governor of the Bank of England, speaking here.
Okay, well, Lorna, thank you. I think that Mark Carney is just being introduced, so we'll listen in now.
With my team at the Banks Agency here in Scotland, our day job is to speak to businesses and organisations, many of whom are here today, and to pass that intelligence back to the policymakers at the bank. One of the aspects of the role that I particularly enjoy is the opportunity to bring those policymakers up to Scotland to come and speak to all of you directly. Today I'm delighted we have our Governor, Mark Carney, to address us. Mark became Governor last July, having previously been Governor at the Bank of Canada. Governor Carney has a wide-ranging experience across both the public and private sector. And I think like you, are very much looking forward to hearing his speech today. Governor.
Good. Thank you very much, Will. I'd like to thank SCDI, City of Edinburgh, all of you for your hospitality and make me so welcome. It's an absolute pleasure to be in Scotland today and to have an opportunity to hear directly from businesses about the economy here, because it provides insights not just to the economy across the UK, but more broadly across the globe. The recovery that began in Scotland is now taken hold in the United Kingdom, with the economy growing across the United Kingdom at its fastest rate since 2007. Now, a few quarters of above-trend growth driven by household spending represent a good start, but they're not sufficient. Even though unemployment is growing, even though employment is growing. Unemployment isn't growing, that's a good thing. And unemployment has fallen, particularly recently in Scotland, where it's well below the national average. The recovery has some way to run before it would be appropriate to even consider moving away from the emergency setting of monetary policy. The Monetary Policy Committee has noted that when the time eventually comes to increase interest rates, any such move would be gradual. And we hope that that helps reassure businesses here in Scotland and all around the UK that the path of interest rates will be consistent with achieving a sustained and balanced recovery in the face of the remaining headwinds that are stemming from the financial crisis. Now, Scotland, as you all know, is a land rich in history and ideas, but it's one to which I owe a great debt. Scots built the very foundation of my native land, Canada, provided the first Prime Minister of Canada, Sir John A. Macdonald, who was born in Glasgow. Scots have shaped the modern world through their contributions to culture and science, and the pioneering work of Scottish economists, from Adam Smith to my former supervisor, Sir James Mirrlees, have had a great influence on my profession. Among them is David Hume, who was born just a short walk from here, and although he's best known as a philosopher, he was a great friend and collaborator of Smith, and he wrote an essay of the balance of trade, which set out a theory of how trade imbalances between nations sharing a currency would self-correct as inflows of money to the surplus countries raise their prices and reduce their competitiveness. Now, Hume, of course, was an empiricist, and he would doubtless admit that the recent Eurozone experience of persistent current account deficits leading not to self-correction, but instead to crisis, requires a more elaborate explanation. And we're fortunate that over the years, economists have obliged with a substantial body of work on the economics of currency unions. And given the recent focus here on the currency, and given the fundamental role of the Bank of England in maintaining monetary and financial stability across the United Kingdom, I want to spend some time today drawing on that body of economics to review some of the most important issues with respect to monetary union. Now, I'm going to stick rigidly to what Thomas Carlyle described as the dismal science, and 20 minutes later you will know why he did so. Any arrangement to retain sterling in an independent Scotland would need to be negotiated between Westminster and Holyrood, and the Bank of England would simply implement whatever monetary arrangements were put in place. What follows is not an assessment of whether Scotland would be overall better or worse off under independence. That's a multifaceted judgment for the Scottish people. And it doesn't pass judgment on the relative merits of the different currency options for an independent Scotland, but instead draws attention to the key issues. This is a technical assessment of what makes an effective currency union between independent nations. So let me start by outlining the basic rationale for sharing a currency. And it was the economist Robert Mundell, a Canadian I might add, who first wrote about what determined an optimal or optimum currency area. And since then, others have elaborated and extended his work such that we now have a fairly comprehensive sense of the costs and benefits of sharing a currency. For Mundell, the main benefit was eliminating transaction costs associated with using and switching between currencies. And just by way of example, studies for the euro area put these transaction costs at about 0.5 percentage point of GDP. And that's, of course, an annual saving. Sharing a currency can also promote investment by reducing uncertainty about currency movements and giving businesses access to deeper, more liquid financial markets. It can reduce borrowing costs for countries with a history of high inflation and currency devaluations. And of course, that was one of the motivations for many countries to join the ERM and ultimately the euro. Sharing a currency can also help promote integration by eliminating one of the barriers between markets and improving the transparency of pricing and increasing competition. And finally, sharing a currency can also help increase the mobility of labor and capital, raise the trade in goods and services, and improve the flow of technology and ideas. And in these ways, members of a currency union can exploit more fully comparative advantage and ensure greater dynamic efficiency, consistent with the objectives of a CDI. Now, set up against those benefits are some potentially large costs of giving up an independent monetary policy tailored to the needs of the region, and giving up a flexible exchange rate that can help absorb shocks. A flexible exchange rate, in particular, acts as a valuable shock absorber when domestic wages and prices are sticky. For example, suppose demand for a country's exports falls. All else equal, its output will fall, unemployment will rise, and its current account will deteriorate. With an independent currency, an exchange rate depreciation can dampen these effects by improving competitiveness. And of course, at the same time, monetary policy can become more accommodative, supporting demand and employment. However, if a country were part of a currency area with that foreign market where the demand fell, its exchange rate would by definition not change, putting the full weight of adjustment on wages and unemployment, which is a significantly more protracted and painful process. In addition, the responsiveness of monetary policy to weak demand in that country would be diluted by the needs of the broader membership. Being in a currency union can amplify fiscal stress and increase both the risks and consequences of financial instability. So in the situation I just described, ideally fiscal policy would help smooth the adjustment to the external shock. But its ability to do so could be limited by the budgetary impact of the falls in output prices and wages. And to maintain credibility, fiscal policy may even become pro-cyclical, with the resulting austerity exacerbating the initial fall in demand. In the extreme, adverse fiscal dynamics could call into question the country's very membership of the currency union, creating the possibility of self-fulfilling runs on banks and sovereigns, absent central bank support. And of course, such feedback loops turned recessions into depressions in several European countries in recent years. So what makes a successful currency union with that backdrop? Well, the success of a currency area hinges on whether its features mitigate the costs of losing the flexibility that comes from an independent monetary policy. And these features generally promote alignment of economic cycles and the maintenance of price and financial stability within the Union. Now, the most obvious feature is similarity itself, similarity amongst members. The idea being similar economies won't suffer from a one-size-fits-all monetary policy. But somewhat surprisingly, a review of major currency areas suggests that similarity is neither necessary nor sufficient for success. For example, the industrial structures of the core and periphery of the euro area are more similar than those of the constituents of either Canada or the United States. Few would argue that the euro area is the most effective currency union of the three. Conversely, the Canadian monetary union works well despite having substantially larger industrial variation than the U.S. The similarity of the industrial structure of Scotland and the rest of the UK depends on how offshore oil is allocated. With oil split on a per capita basis, Scotland and the rest of the UK look about as similar as the core and the periphery of the euro area, i.e. quite highly similar. But with oil split on a geographic basis, they look about as diverse as the United States. Now, despite any differences, the facts are that the close integration of the Scottish and the rest of UK economies has helped ensure that their economic performance has been very similar over a long period, and output growth is highly correlated. So theory notwithstanding, being similar doesn't necessarily help, but being different doesn't necessarily hinder. That suggests we should look elsewhere for the ingredients of a successful union, to the mobility of labor, capital, and goods, to institutional structures that promote financial stability, and to institutions that mutualize risk and pool fiscal resources. So let me start with the first. The 5 tests formulated by the UK government to analyze the merits of joining the euro in 2003 were crafted in large part around the degree of integration between the UK and the euro area. And that's because greater openness and integration within a currency union not only enhances the benefits of a shared currency, but can mitigate the cost of losing exchange rate flexibility. Mundell and other economists originally argued that currency areas should coincide with regions which had high internal labor mobility. The idea being that by moving from areas where demand has fallen to areas where it has risen, workers would help moderate changes in wages and unemployment. Fairly straightforward. Now, in Europe, there are clear practical impediments to labor mobility, including language and culture. And as a consequence, Europe has a much lower cross-border mobility than the US, Canada, Australia, or the UK. And this has contributed to the need for painful internal devaluation in some countries in the Eurozone in order to restore competitiveness. So given that more than 700,000 Scots live in the rest of the UK, and over 500,000 from the rest of the UK live in Scotland, one would be tempted to assume that labor mobility between the two is high. In fact, gross migration flows between Scotland and the rest of the UK, while greater than the European countries, are much lower than the US, Australia, and Canada. And that probably, in part, reflects the fact that economic conditions in Scotland and the rest of the UK have been quite similar, very similar, such that the incentive for migration is relatively limited. It's reasonable to think that similarities between Scotland and the rest of the UK mean that there is potential for higher labor mobility should that become necessary. Given differences in industrial structure, this would put a premium on ensuring that barriers to labor mobility are not allowed to develop if monetary arrangements were to change. Now, it's not just an integrated labor market that helps adjustment within a currency union. Openness to trade and free movement of goods also assists in diluting the effects of shocks by spreading them across that union. And this helps to align economic cycles and make common monetary policy more appropriate. Here, Scotland and the rest of the UK are highly integrated. 70% of Scottish exports are destined for, and 74% of imports into Scotland come from the rest of the UK. However, there's a word of caution here. There is a wide body of evidence that national borders can influence trade flows, even between otherwise highly integrated economies. And the high degree of integration between Scotland and the rest of the UK may in part depend on their being part of the same sovereign nation. Mobility of capital can also promote necessary adjustments to shocks. Moreover, if capital in one part of the Union is owned by those in other parts of the Union, the effect of a shock is diluted across the Union. Simply put, risks and rewards are shared. Similarly, the ability to borrow from other parts of the currency union in deep and liquid cross-border capital markets or integrated banking systems allow one part to smooth out temporary falls in incomes. However, it has to be noted that free movements of capital can be a mixed blessing. If the funds provided by one part of the union to another can be withdrawn easily, these outflows can, if the right structures are not in place, undermine the economic and financial stability of all members. And that brings me to the second feature of a successful currency union, which is a banking union. Effective currency unions need a wide range of institutions to support an integrated and efficient banking sector. And these are often referred to as a banking union and include common supervisory standards, access to central bank liquidity and lender of last resort facilities, common resolution mechanisms, and finally, a credible deposit insurance schemes. Without a banking union, cross-border capital flows can be restricted, the effectiveness of monetary policy impaired, and in the extreme, the very viability of the union undermined. Now, it's as difficult to separate the institutions that support banking union from national fiscal arrangements as it is to separate the creditworthiness of banks from their sovereigns, and give me a moment to explain. In recent years, doubts about the resilience of major financial institutions have created expectations of sovereign support. The scale of those potential liabilities can in turn generate doubts about public finances, undermining the resilience of both banks and sovereigns. When such concerns emerge, the consequences can be dramatic. The banking systems of peripheral European countries experienced outflows of between 10 and 85% of total deposits from elsewhere in the Eurozone in the 3 years following June 2010. Bank funding spreads in those countries ballooned by more than 5 percentage points, and bank lending to the real economy collapsed, and credit conditions tightened massively. So clearly something needs to be done about these structural issues. It's in the interests of all countries, whether they're in a currency union or not, it's in the interests of all countries to sever the link between banks and sovereigns by ending too big to fail. And governments must put in place regimes that impose losses on banks' management, shareholders, and creditors rather than the taxpayer. And the Bank of England is at the forefront of efforts to establish common global requirements to do just that. And I will say that 2014 is the key year to complete the job here. Now, well, ending too big to fail, if we're successful in ending too big to fail, that should mean that taxpayers no longer have to bail out banks. It won't fully break down the bank sovereign loop for 3 reasons. Banks. It won't fully break down the bank sovereign loop for 3 reasons. The first is that banks hold substantial amounts of their national government's debt in order to manage liquidity, meet collateral obligations, and hedge exposures. European banks hold more than 1 trillion euros of home country sovereign debt, amounting to about 5% of their total assets. The second is that confidence in deposit guarantee schemes relies on a national fiscal backstop. Europe is currently engaged in a process to try to build such institutional arrangements for a common insurance scheme. And I think that process shows some of the difficulties. It's difficult to do that across sovereign nations because, in effect, mutualized deposit guarantee schemes imply a pooling of risk and a loss of sovereignty. And all member states must be persuaded that they won't be simply left with the bill for the mistakes of others. Now, third, a currency union requires a common fiscal backstop for the central bank. This is pure self-interest here for the Bank of England. Central banks must be able to act as lender of last resort, both to financial institutions that are solvent but are experiencing an unwarranted loss of confidence, but also to provide bridging to institutions that are being recapitalized under those new resolution regimes that I just talked about a moment ago with respect to too big to fail. Under current governance arrangements in the United Kingdom, these operations require an indemnity from and the approval of the Chancellor because they would put substantial public funds at risk. The existing banking union between Scotland and the rest of the United Kingdom has proved durable and efficient. Its foundations include a single prudential supervisor maintaining consistent standards of resilience, includes a single deposit guarantee scheme backed by the central government, and a common central bank able to act as lender of last resort across the union, also backed by the central government. These arrangements help ensure that Scotland can maintain a banking system whose collective balance sheet is substantially larger than its GDP. The euro area has shown the dangers of not having such arrangements, as well as the difficulties of the necessary pooling of sovereignty in order to build them. An independent Scotland would need to consider carefully how to develop arrangements with the continuing United Kingdom, arrangements that are both consistent with its sovereignty and sufficient to maintain financial stability. So let me turn to the third aspect, which are fiscal arrangements. While banking union requires common fiscal backing, there are two broader justifications for shared fiscal arrangements within a currency union. The first is that deeper fiscal integration between members can play an important role in smoothing shocks that affect only part of the currency area. It's no coincidence that effective currency unions tend to have centralized fiscal authorities whose spending is a sizable share of GDP. Those centralized fiscal authorities, if you look across a range of currency unions, their spending averages about a quarter of GDP for all advanced economies excluding the Eurozone. And that offers scope, this central authority offers scope for a significant degree of stabilization, much of which happens automatically as slowing growth in one part of the Union causes tax revenues there to fall and welfare spending to increase. Those automatic fiscal stabilizers are important in the UK, and it's estimated that for every pound that output falls, the reduction in taxes and the increase in transfers are together worth about 50 pence. Now, what matters for individuals is the extent to which this risk-sharing insulates their disposable income from shocks. In the UK, the estimate is that around a fifth of the variation, 20% of the variation in regional personal income relative to the national average is stabilized by central government transfers. And that's probably an important factor accounting for some of the close harmonization in economic performance across the UK. The degree of stabilization in France and the United States is similar. It's slightly lower in Canada. Fiscal stabilization is particularly important in a currency union because it helps mitigate the loss of exchange rate flexibility. But it has to be noted that being in a currency union can amplify fiscal stress for individual nations, limiting their ability to perform this valuable role just when it's most needed. So it makes sense to share fiscal risks across the whole of the area. If you do, a localized shock, pardon me, is less likely to stretch the fiscal position in a larger, more diversified currency area, especially if the shock shifts demand between the parts. That's what makes a given shock in Nova Scotia less severe than one in Portugal. Now, the other justification for shared fiscal arrangements is that problems in one country are likely to spill over to others. For example, the threat of default by one country may trigger a more generalized crisis, particularly if the liabilities of the crisis country are held by the banking system of the broader currency area. So it's in the interests of other countries in the Union to bail out the country in crisis, and that reduces the incentives for the countries to run their finances prudently in the first place. At a minimum, this so-called moral hazard problem suggests the need for tight fiscal rules to enforce prudent behavior for all in the Union, although credible sanctions for breaking those rules have proven hard to develop elsewhere. Now, there's an obvious tension between using robust fiscal rules to solve a moral hazard problem and allowing national fiscal policy to act as a shock absorber. And this just reinforces the case for fiscal risk sharing between nations. So it was no surprise that the presidents of the European Council, European Commission, Eurogroup, and the ECB recently argued that European monetary union, which has so far relied only on fiscal rules, will not be complete until it builds mechanisms to share fiscal sovereignty. And the possible options there range from a transfer union to pooled employment insurance mechanisms or some combination. Whatever is ultimately chosen, the degree of fiscal risk sharing will likely have to be significant. So similarly, in a monetary union between an independent Scotland and the rest of the UK, the two parliaments would have to agree on whether fiscal rules were sufficient or whether similar risk-sharing mechanisms were necessary. So let me move to conclusion. The Scottish Government has stated, in the event of independence, it would seek to retain sterling as part of a formal currency union. All aspects of any such arrangement would be a matter for the Scottish and UK parliaments. If such deliberations ever were to happen, they would need to consider carefully what the economics of currency unions suggest are the necessary foundations for a durable union, particularly given the clear risks if these foundations are not put in place. Those risks have been clearly demonstrated in the euro area over recent years, with sovereign debt crises, financial fragmentation, and large divergences in economic performance. The euro area is now understandably beginning to rectify its institutional shortcomings, but further, very significant steps must be taken to expand the sharing of risks and the pooling of fiscal resources. In short, a durable, successful currency union requires some ceding of national sovereignty. It's likely that similar institutional arrangements will be necessary to support a monetary union between an independent Scotland and the rest of the United Kingdom. Now, I suspect, as predicted, it's good to have some of our predictions come true, that you've now reached the limits of your endurance of the dismal science. So you'll be relieved to know that economics can take us no further, or at least I won't take the economics any further. Decisions that cede sovereignty and limit autonomy are rightly choices for elected governments and involve considerations well beyond mere economics. And for those considerations, others are far better than the Bank of England to comment. So with that, thank you for your attention. I'm happy to take questions.
Yeah, thank you. Thank you for that, Governor. So we've got a short period for some questions. We'll start over there, please.
Thank you very much, Governor. Alistair Ross, St Mason's law firm. You very helpfully said at the start of your remarks that you made clear the bank's role in the event of Scottish independence, that it would be an implementation role based on whatever was agreed by the two governments. But can I move slightly forward from that and ask, is the bank intending to make any other interventions in the independence debate ahead of the 18th of September?
Okay. I don't know if you heard the question, but it was, in effect, does the bank intend to make any other interventions ahead of the, with respect to these issues in advance of the referendum? And the short answer is no, we do not. The issues that I've tried to raise here go directly to our responsibilities, but in commenting on them, we've respected our independence, enforced our independence by speaking directly to the economic issues, the underlying economic issues, not opining on solutions to those economic issues, and certainly not commenting on the broader question of the relative merits of specific types of monetary arrangements or the broader questions, economic questions of independence. Now, the only caveat I'll say is that as an independent institution, we are accountable, as you would expect, to the people of the United Kingdom. That accountability is discharged in many ways. Answering your questions is one of them. But there's also answering questions of parliamentarians. I would be surprised if we weren't asked questions, myself, my colleagues, weren't asked questions on this issue in coming months. But the core is we look at this from a technical perspective. From an economic perspective, we're not going to provide advice. We're not, as I said at the start, we're not passing judgment on these issues.
Thank you. Other questions? Go on.
Hello, Haig Bathgate from Turkin-Connell. Thanks for that. I was wondering if I could just go back to the start of your speech and just the wider economic position that we're in at the moment, and particularly whether you'd be able to comment on sterling's strength of late, just given the current account deficit position that we have at the moment now, I think a 24-year high, and just how that's featuring in your thinking about getting more balance into the economy. The other question I had just as well at the same time was on the impact of the US on your thinking around interest rate policy, just in relation to forward guidance, and the fact that the yield curve has shifted up despite your comments on keeping rates lower for longer.
Okay, boy, you packed a lot in there. In terms of sterling, we don't. In general, we avoid commenting on the level of the currency or providing a running commentary on the currency. It has been the behavior of the currency has had important influences on inflation. Over the course of the last 5 years, the depreciation flowed through relatively quickly to prices. It was one of the reasons why inflation was above target for several years. We would expect some pass-through of sterling strength to help reinforce other forces that are helping to create a more benign inflation environment. More benign, I didn't say totally benign, but more benign inflation environment. And they include global disinflationary pressures, price movements in the Eurozone, in the US are quite weak. The commodity prices as a whole, apologies to friends in Aberdeen and beyond, have been weaker than recent past, down about 10% over the course of the last 6 months. So you see, it's within a context of providing some dampening. It provides some dampening to the inflation outlook, which obviously affects or is one input into the stance of monetary policy. And in terms of the U.S., it's a little tough. It is a pretty long answer around the U.S., and I'll spare you that, which obviously is incredibly important what happens in the U.S. I would say that I spoke about this last week. There are some real similarities in the stance of monetary policy or the strategy of monetary policy between the UK and the US. We are not continuing with asset purchases, so that's different as a tactic. But the general question is how much slack is there in our economies, and to what extent can providing accommodative policy encourage sustainable demand to pick up some of that slack. We provided, for the first phase of forward guidance, we used the 7% unemployment threshold to give businesses in Scotland and across the UK confidence that we weren't going to prematurely withdraw monetary stimulus. The MPCs signaled that we don't see any need for an immediate adjustment to that policy, and we will provide further thinking on guidance in the coming weeks. But I will say one last point for those who don't follow the markets, maybe as closely as you may well, that well, the market has had a different view on when the unemployment threshold was going to be achieved, and the market view has been closer to the base case forecast of the bank. The market has clearly taken in that 7% is a threshold, not a trigger, and in fact, market expectations of when we would raise interest rates are still in 2015 and the first quarter of 2015, which is consistent with that.
Thank you. We have one.
Yeah.
Yeah, okay. Thank you, Governor. Can I take you back to the beginning of your speech when you talked about a good start and consumer spending at the rate that it's got driving an economic growth? My question to you is really around the sustainability of that and the extent to which, why do you not think exports have done more to facilitate economic growth? And do we have a sustainability of sort of 2% growth without business investment?
Yeah. It's the question, so thank you for it. In terms of the sustainability of consumer spending, there is a sustainable rate of consumer spending, but it's slower than the rate we've seen in the second half of 2013. What we saw with the pickup of growth was a fall in the savings rate, quite a notable fall in the savings rate from precautionary levels to more normal levels. But as you can appreciate, you only make that adjustment one time. And then what drives consumption is our wages and employment. We're getting the employment, but we're not seeing the wage growth, and you bring that together, and that leads us to expect that the pace of consumption growth, the pace of household spending as a whole, including housing investment, will gradually slow over the course of coming quarters, which makes it that much more important that we see investment pick up and ultimately net exports picking up. I think we feel better about the former than we do about the latter, partly on the latter, partly because of the earlier question on sterling, but more fundamentally because, well, risks in Europe are now a little more balanced. This is, in the words of President Draghi, this is a weak, uneven recovery, modest recovery. It's about a 1% growth in Europe, which is well below, and it's still our major export market. So we're not getting that big demand boost out of Europe, and success there will turn on, there and beyond, will turn on productivity improvements, which will be driven by investment. On investment, I said the news is a little better there, in that we are starting to see in the figures that there is some pickup in investment. There was in the third quarter. Certainly from a survey perspective and conversations, including conversations we had this morning with some of you, the mood is a little better on the investment side, a little more of a shift from focusing on operating expenditures towards capital expenditures. I wouldn't overplay that. And then finally, to bring it back to the stance of monetary policy, that's feeds into an environment where we're trying to provide certainty, as much certainty as we can, to businesses that the stance of policy, there may be some changes at some point, but the stance of policy will be consistent in the economy getting sustained momentum, and that's not going to come from the household sector.
Thank you, Governor. Happy to take one more question. Bill's got.
Yes. Mark, just to say thank you again on behalf of SCDI members for coming up today. It's been extremely insightful. When are you coming back to Scotland?
I am. That's whenever you'll have me. I think at the latest, I will come back in the summer. We were talking at lunch. I mean, I tend to get up for some of the Commonwealth Games, if I can get that. Can I plug the Commonwealth Games there? Which is a great event, and I'm looking forward to that. I will say that, obviously we have Will, Ian, and their colleagues here from the Banks Agency, but my colleague Martin Taylor, who's on the Financial Policy Committee, was up in December. We had another colleague of mine from the regulator, PRA, was up a couple of weeks ago, Sam Woods, or last week even. We have another MPC member, Ian McCafferty, is coming up within the next 2 months, I think. So, you'll be sick of seeing the Bank of England, but we'll be up, and I'll look forward to seeing a bit of the games with you, if you don't mind, Bill. Thank you all.